Hello everyone, you're watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, welcome back to Saheb Academy. Now today in this video we are going to start this new chapter of cost accounting. As you can see over here, contract costing. And this chapter is a very simple chapter, and there's a good weightage also in the exams. If you do this chapter properly, then believe me, you'll score good marks. And then if you understand the concept of this chapter properly and the format of contract account, then this chapter would be very easy for you, believe me. So let's start this chapter. Let's try to understand what is contract costing and what we have to do in this chapter. Now first let's discuss about what is a contract. See here, it's very simple. A contract is an agreement between the two parties under which one party is called contractor and the other party is called contractee. Now who is contractee and contractor? Contractee is the person who gives the contract and contractor is the person who undertakes the contract, who agree to do something for the other party, right? So now this contractor would not do that for free, of course. He will charge something. So that price which he charges and on which both the parties agrees upon, that's called contract price. That's called contract price. So this is what basically a contract is. Now here in this chapter, in this contract costing chapter, we are mainly concerned with construction contract. We are talking about here construction contract, like construction of building, roads, bridges and all these things. Flyovers, towers. Yes. So now here in this chapter, who would be the contractor? Contractor would be the builder. Because the builder is the person, right, who construct all these things. Yes, who arranges all the resources like labor, material, overheads, etc. to carry on the particular work and get the building, roads and bridges ready. Yes. So contractor is the builder here in this chapter mainly, and the contractor would be who? The contractee will be the the customer or the client of the builder who gives the contract. Yes. So this is what. And then these type of projects, right, these construction projects, it takes long time to complete. More than 1 year usually. They take like 5 years, 10 years, like that. And there will be huge resources involved here in these type of construction contract. And then contract work, the actual work which builder will be doing, it is done where? It is not done at the place of the contractor. No, it is done at a place where the contractee, the customer wants it. Wherever the client wants the bridges, the building, at that place, the work will be done, isn't it? So the work will be done at where? It will be done at a site. It will be done at a site, at the place of the contractee. And then the expenses which are incurred in these type of contract, they will mainly be direct nature expenses. Direct expenses, because it would be of material, labor, plant and machinery and all those things. And then there will be a small portion of expenses which would be incurred as indirect expenses, such as office expenses, stores, marketing expenses and all that, right? So this is regarding the construction contract. And as you understand, this is what a contract is. Contractor, contractee. Contractor is the builder, contractee is the customer of the builder. Now as a student, what we have to do over here about this chapter, we have to do this chapter entirely from the point of view of this party, from the point of view of builder, contractor. We do this chapter from the contractor's point of view, right? Because the contractor is interested in finding out the profit or loss that is made by each of the contract. Suppose, let's say, this contractor has 4 contracts going on at 4 different sites. Site 1, site 2, site 3, site 4, right? So for each of these sites, for each of these contract, what he will be doing, he will be preparing a separate contract account, which is a nominal account. We'll see that in a second, the format of that. So he will open a separate account for each of the contract to find out the profit or loss made by each of these contract in a year. Now mainly what will happen, almost all the time, the contract will take long time to complete, usually more than 1 year. So for every year a contract account will be open. And till the contract is completed, you will have to keep on opening the contract account for each of the years and find out the profit or loss that is made by each of the contracts. Fine. So this is what we have to do basically. Now what we have to do, we have to understand the concept of this chapter properly. This is just a basic rough idea that I've given you now. But now what we have to do, we have to see the format of contract account, and not just the format, whatever that is there in the format, each of these things we have to discuss this properly. So that's what we are going to do. Okay, let's discuss the format and each of the content that is there here. Let's understand the format. Now see, the format of contract account is very simple. See, it's same like trading and profit and loss account. It's just a nominal account. All the expenses over here and all the income and closing stock on the credit side. See, the basic technique of preparing the contract account is you have to see from the point of view of contractor, because we do this chapter from contractor's point of view, and this account is also prepared in the books of contractor. Yeah, the contract account, it is prepared in the books of contractor, because this party is interested in finding out the profit or loss that is made by each of the contract, right? So here, as I said, it's same like trading and profit and loss account. So what you have to do is, whatever you have put into the contract, you have to take that on the debit side, and whatever you get from the contract, yeah, in return, all the incomes and the closing stock, whatever you get out of the contract, you have to take it over here. Simple as that. That's the basic idea to prepare the contract account. All right, so that's what we have to do. Yeah, and then the profit or loss made by the contract will come on the, you know, profit on the debit side and loss on the credit side. Now here there's a bit tricky part regarding the old syllabus and the new syllabus that we have to understand properly. Don't worry. Okay, so old syllabus I mean for the BCOM and IPCC students, and new syllabus CA Inter students, right? So that's what. So this is just the format of contract account. Now what we have to do, we have to go to in detail and, you know, discuss each of the concepts over here. Yeah, small concepts, and yeah, let's do that. Now see, the first thing that we have over here on the debit side of the contract account is the material, to material. Now what is this? See, whatever the material the contractor puts into the contract, it will come over here on the debit side, to material. But then what is this below the material, all these things, all these lines? See, it's very simple. It is just a breakdown of the material figure. Okay, opening balance, directly purchased, and all that. So let's understand that one by one. See, opening balance is the balance that you had from the previous year. If you're preparing the contract account for the second year of the contract, yeah, then what will happen? From the previous year, you will have some materials from the side that you will take it over here. Opening balance. Clear? Yes. Then what is this directly purchased? Directly purchased means what? You go directly to the market and you have purchased the materials. Yeah, that's what directly purchase is, right? Then what you have here is supplied from stores. What's supplied from stores? See, what you will do, you are a contractor, right? You have a company and you have a lots of contract going on. So what you will do is, whenever the market price of some materials will be reduced, yeah, it will get low, what you will do, you will purchase in bulk and you will store it in your warehouse. Then whenever the contract at the side, they require the material, cement, whatever it is, what you will do, you will supply from your stores. Clear? So that's what supplied from stores is. So in a way, what you're doing over here, you are, you know, putting the materials into the contract, yeah, supplied from stores. So you have to debit that over here. Right, by debiting I mean you have to add it here, right? And then what we have is transferred from job and transferred to job. Now what is this? See, it is just, you know, inter-transfer between the contract, that's all. See what is happening over here. Sometime, you know, let's say the B contract immediately required some materials, and let's say they don't have time to go to the market or the store because they are very far. So what they can do is, you know, they can directly take the material from other side. Yeah, the people from this side will go to the site C, to the contract C, and from there they will get the materials. Yeah, that can also happen, inter-transfer of, you know, materials. Fine. So if that happens, what you have to do, the contract which is receiving the materials, yeah, in that contract account you have to debit that. Transferred from job, you have to add, right, because they have received it. Yeah, and then from the contract from which the material has gone out, what you have to do, what did I say you, whatever goes out you have to credit, whatever comes in you have to debit here, right? Whatever you have put into the contract, it has to come over here. Whatever that has come out of the contract, it has to come over here. Yeah, that's a basic technique. But then here, you know, what we'll do is, we'll not take it on the credit side. What we are going to do is, we are just going to take it in minus. If we do that, then that also works, and that's what we will be doing. Okay, transfer to job, we have transferred the materials to some other contract. Simple. Yeah, easy. You understand that? Transferred from job and transferred to job, right? So that's what regarding the material is. Then what? Then we have labor, supervision, overheads, all these expenses will be debited over here. As I said, right, it's a simple nominal account, same like trading and profit and loss account. What you have to do, whatever, you know, you have put into the contract, whatever expenses you have incurred, you have to take it on the debit side, to labor, supervision, wages, all these things, overhead, general overheads, and all that. Fine. And then we have plant, yeah, to plant opening balance, to plant depreciation here we have, and then on the credit side also here we have by plant closing balance. Now what is this? Let's understand this properly. See, plant means the asset, yeah, the machinery, the trucks, or whatever equipment you purchase for the contract, because you have to use them in the construction, right? So see, it's very simple to understand the treatment regarding this. Yeah, there are two options that you can do over here. Now when you purchase the asset, tell me what's the main expense that you have to, you know, incur on the asset. The main expense is the depreciation, isn't it? Yeah, you have to purchase the asset and all, but then do you expense it in this year? No, you take the asset value to the balance sheet, right? So you will not be expensing it over here. The only expense that you incur on the asset is depreciation. Yeah, every year what you do, a part of the asset is expensed into the profit and loss account. Yeah, that's what you do, right? So similarly here, if an asset is used for the contract account, then what you have to do, you have to charge the depreciation of that asset to the contract account. That's what you have to do. Okay, that's the treatment regarding the asset. Yeah, the depreciation. Fine. So there are two ways to do that. See, it's very simple. Yeah, the first option that you have is, yeah, the first thing that you can do is take the opening balance of the asset, whatever the opening balance was. Either you purchase the asset for, let's say, 1 lakh. Yeah, either you purchase or you had opening balance of the asset from the previous year. Yeah, so you will take opening balance and then you will take the closing balance after charging the depreciation, the written down value. Okay, right? So 100 was the opening balance and the closing balance was 80. How 80? Because let's say there is 20 depreciation. Fine, 20,000 depreciation, so the closing balance is 80. So that's one way of treating the plant. Okay, opening balance and closing balance. So depreciation is automatically adjusted. You don't have to show depreciation over here and all. No, because it's automatically adjusted. Why? Because there is excess of debit over here, right? So it is automatically adjusted, right? And this option is preferred when the machinery or truck or whatever the asset plant is, it is specifically purchased for this contract only. Yeah, if it is like that, then you have to go for this option. Take opening balance and closing balance. Opening balance and then closing balance at written down value. Fine. And then the second option which you have is, see, just take the depreciation on the debit side. That also works. Yeah, if you take the depreciation, just depreciation 20, then also what will be happening, the excess of debit will be there, and then you have taken the expense of asset, isn't it? Here also the same thing is happening, isn't it? You are showing excess debit of 20 over here, and here also excess debit of 20. The accounting treatment is same, just the presentation is different. Here the opening balance and the closing balance, but the net figure which is affecting on the debit is only 20. Here also 20. So the net treatment is same. Yeah, just the presentation is different, and this option is preferred when plant is used for certain days for this contract. Now what can happen is, now there are lots of contracts are going on. Let's say, yeah, contract 1, contract 2, contract 3, contract 4, and let's say the contractor has one truck, right? So now what the contractor is doing, let's say he has used the contract in a year, the truck for a year, let's say 100 days over here, 50 days over here, 50 days over here, and then 20 days over here, like that. Yeah, so that can also happen. If something like that happens, yeah, the asset is used for certain days in certain contracts, then what you can do is you can only charge the depreciation. Yeah, plant used for 100 days, let's just say, then what you can do, whatever the depreciation is, let's say the depreciation is 20,000. Yeah, so 20,000 into 100, it has been used for 100 days divided by 365. So this much depreciation, 5,479.4, this much you will charge in the contract account. Yeah, so there are two options to treat the plant. Either take the opening and closing balance or just take the depreciation. Now this is the preferred option if the asset is specifically purchased for a contract, and this is a preferred option if the asset is not specifically purchased and it has been used for certain days. Yeah, so there are two treatment. Okay, either take opening balance and closing balance, opening balance and closing balance, or what you can do is just take the depreciation. Yeah, it's or, not both. Okay, or. Is that clear? Yeah, so that's regarding the treatment regarding the plant, machinery, asset, whatever it is. Fine. And then what we have, see, and then we have this work in progress. Let's not go to that now. Yeah, let's discuss this. See here, buy bank sale of plant, buy bank sale of material. Now what can happen in a contract if you have plant which is of no use to you or material of no use to you? Then what you can do is you can also sell the material. If you're selling the material, then what is happening? It's an income for you, isn't it? So that will come over here, and the plant and material has gone out of the contract. It has gone out of the contract, so it will come over here. Yeah, two way you can think. Either you can see it as an income, or you can think like plant is going out, material is going out. Yeah, so it will come over here, buy bank, simple as that. But then when you are selling these guys, yeah, the plant and the material, what can happen? Either you can sell them at a profit more than the cost or less than the cost at a loss. Yeah, isn't it? So profit or loss can be there on the sale of plant and material. So that also you have to record properly. If it's a profit, yeah, then you have to take it on the debit side. True profit and loss, true profit and loss. Profit on sale of plant, profit on sale of material. Is that clear? Yeah, because what is happening, see here, let's say you had material of 10 rupees. Yeah, and you are selling it for, just for an example, simple, rough example I'm giving you. You had material of 10 rupees, you're selling it for rupees 12. Okay, so credit is more by 12 and here it is 10. Yeah, on the debit it is 10, here it is 12. So what you're going to do, you are going to take the profit over here, rupees 2. Is that clear? Then the debit will be equal to the credit. Okay, is that clear? Did you get that? So profit on sale of plant and material will come on the debit side. Keep that in mind. Yes. And then what will happen? You are taking here as two profit and loss. Later it would go and it would hit where? It would hit profit and loss, the general profit and loss. Yeah. So see here, let me show you the treatment properly. See, sale of materials or sale of plant, also the same things. The treatment is same. What you have to do, buy bank account, credit side of contract account. Yeah. And then if it is a profit, it would go where? Profit and loss account, credit side. Loss, profit and loss account, debit side. If it has to go on credit side, if it is a profit, then in contract account you have to take it on debit side, isn't it? In contract account, if you take that on debit side, then only it will go opposite co-posting in the profit and loss, isn't it? So that's what. Okay. And if it's a loss, it has to go on debit side of profit and loss account. You know that, right? Profit and loss account, all the incomes are taken where? On the credit side of profit and loss, and all the expenses are debit on side on the profit and loss, isn't it? So it has to be gone like that. Then in contract account you have to do opposite, isn't it? In contract account, for loss you will take it on the credit side. Here, see here, where is it? Yeah, by profit and loss, loss on the sale of plant, loss on the sale of material. Is that clear? So profit on sale of material, loss on sale of material. You get that, right? Simple. So same thing with the plant and the material. The treatment regarding the material and the plant is same. Is that clear? And then what we have? And then we have abnormal loss of plant and abnormal loss of material. Now what can happen, you know, see, the contracts are going on, isn't it? So what the, you know, the employees or what the workers will do, the workers, they may be careless. Yeah, due to their carelessness, what can happen is some cement and all these things, the materials, they will be destroyed, or the machinery, if they use it inappropriately, the machinery will be destroyed, or something like that can happen, right? So if there is any damage, material loss, material theft, yeah, if anything is stolen, due to all these things, what is happening? Due to all these things are going out of your contract, isn't it? If you're, you know, the materials are stolen, the machinery is not working for you, it has been, you know, what do you say, it has been damaged, then what is happening? It's no longer in your contract, it's going out of the contract, isn't it? So you have to take it over here. By profit and loss, abnormal loss of plant, yeah, by profit and loss, abnormal loss of material. What did I tell you? The basic technique of preparing the contract account, the basic logic is whatever you have put into the contract on the debit side, whatever you get out of the contract, whatever that has gone out of the contract on the credit side. So here what is happening? Think properly. Yes, it is a loss and I'm taking over here. Why am I taking loss over here? You just told us, you know, income and closing stocks will come over here. Think properly. These things are hitting directly profit and loss. It is directly hitting where? Profit and loss. So it has to go to where first? It has to go to contract account now here, right? So it will go here on the credit side. Then on opposite posting, it will hit profit and loss. In profit and loss, all the expenses on debit, all the incomes on credit. So this is loss. It has to go to debit side of profit and loss. So first credit side over here and then opposite posting in the profit and loss. Is that clear? So that's what. Or another way of thinking is that it has gone out of the warehouse. Yeah, abnormal loss of plant and abnormal loss of material. We don't have that anymore. Yeah, so it is going out. Okay, you understand that? Simple. Then what do we have? Then we have material return to store and plant return to store. Material at side. Now what is this? These are the closing stocks. Yeah, whatever that has gone out of the contract. Yeah, so material at the end of the year, what will happen? Whatever material that has been left, some of that will be returned to the store, back to the store. Yeah, back to the warehouse. Yeah, it will go out of the contract back to the warehouse. Yeah, it's going out, so it will come over here by plant return to store, by material return to store, and then there will be some material or some plant, yeah, some assets. What can happen? They will remain at the contract side only. If that happens, then that's your closing stock. Yeah, that's your closing balance, which would be the opening balance for the next year. So it will come over here by material at side, and one more thing can come by plant at side also. Is that clear? Yes. Yeah. And then what? That's what I have taken over here, right? By material at side and by plant at side. Yeah, and then this is the closing balance by plant, closing balance. I told you regarding that. Yeah, opening balance and closing balance. Now this is also there. Okay, sometime what can happen? Sometime you know, here it will come to plant at side and here by plant at side. That we can also have. It's simple, opening and closing balance. Yeah, so that's regarding that. So we have covered almost everything now. The only thing that has been left is what? The profit, yeah, the balancing figures and the work in progress. Now what is work in progress and why do we have to take it on the credit side of contract account? What's the logic behind that? See, it's very simple to understand. As I've told you that these type of construction contract, it will take long time to complete, usually more than 1 year, 3 years, 4 years. Yeah, So the work entirely will not be done in the first year itself. Yeah, it will be continued on in the second year, third year, fourth year, like that. Yeah, so that's what, yeah, that's why it's called work in progress. And then why it is taken on the credit side is because it's our main income, isn't it? Why the contractor is paying us the money? Why is he paying us the money? Because we are doing this work for him, isn't it? So that's why this work in progress, it's what? It's revenue, it's income for us. So that's why it's being credited over here. It's taken on the credit side. Simple. Yeah, now here there are mainly three components of work in progress: work certified, work uncertified, and then this escalation. Now this escalation, we'll discuss this later while solving the problem, don't worry. But first here, let's talk about what is work certified and work uncertified. Now see here, what will be happening is at the end of the year, some of the work will be completed and some of the work will not be completed. Yeah, whatever the total work is there of the contract at the end of the first year, just for an example, let's say 80% of the work is completed and 20% of the work is not completed. Fine. So now let's say for example that we are talking about a contract with 1 crore. Yeah, 1 crore contract, right? So 80% work is completed means 80 crores, right? So what will be happening now? The contractor will immediately call to the contractee, see Mr. Contractee, 80% of your work is done, it's completed, please pay us 80 crores. Now, is the contractor gonna pay him directly 80 crores just like that? No, he will not. He will not do that. Yeah, because yes, he can see that building has been constructed somewhat, yeah, somewhat 80%, but you can't say properly it's 80% and all like that. Yeah, so what the contractee will do, he will call his architect. Yeah, he will call his architect. Mr. Architect will come and he will verify that whether the 80% work has been done or not. And 99% of the time, what the architects will do, if the contractor is claiming that 80% of the work is done, always Mr. Architect will say that no, 80% work is not done. Yeah, somewhat 70%, 60%, like that. Yeah, he will always say less. Who? Mr. Architect. Now for example, let's say Mr. Architect told 70% of the work is done, not 80%. So automatically now what has happened, 70% work is work certified and the remaining whatever work that has not been approved by Mr. Architect is called as work uncertified. Simple as that. Yeah, Mr. Architect observed, yeah, and he saw everything and he said that I approve only 70% of the work that you claim to be completed. Yeah, whatever work that you claim to be completed, 80%, right? I tell that 70% of the total work is completed. That's all. Yeah, full and final. So now if the Mr. Architect has given approval of 70%, that means what? That means Mr. Contractor has also given approval, isn't it? So this is as good as sales. This is as good as sales, and we have to value this at contract price, yeah, at the sales price. And the remaining whatever that is uncertified, work uncertified, this 10%, it has to be valued at cost price. Is that clear? Yeah, so this is regarding work certified and work uncertified, and we have to take that properly in the contract account and we have to show the breakdown of that because the valuation is different. Yes, yeah, so that's regarding work in progress. That's what you have to do, and this is like a closing balance. Okay, this is the closing balance. It will be carried forward to the balance sheet. Okay, yeah, then what? Then see, one more thing that you have to understand here properly is the profit or loss. Yeah, that's the main and the most tricky part. Now see, there is a difference over here between the old syllabus and the new syllabus. For CA Inter students, what you guys have to do is, if you have got loss on the contract, you have to take it over here. For the old syllabus and the new syllabus also, yeah, you have to take it over here, loss on contract. Now for the new syllabus student also, you have to pay attention properly, okay? Because see, if you are doing any graduation courses just such as BCOM, BBA, BAA, whatever it is, then also you have to understand this properly. Yeah, so see, if you get balancing figure on the credit side, then it will come over here by costing profit and loss, loss on contract, simple as that. Yeah, and then if the profit comes, yeah, on the debit side, if you get a balancing figure, then what will happen? It's different for the new syllabus students, for the CA Inter students, and for the IPCC students, yeah, and the BCOM students also. So see, for CA Inter students, what you have to do is, if you get a profit, directly you can take two costing profit and loss. Game over. Simple as that. Let me just show you the chart over here. Where is that chart? See here. Balancing figure, regarding the balancing figure profit or loss. If there is a loss, you have to take it on the credit side by profit and loss. Game over. Simple as that. Yeah. This is for both of them. Okay. For the new as well as the old syllabus. Both. For the BCOM, old syllabus, IPCC students, CA Inter students. Yeah. If you get a balancing figure on the credit side, yeah, that's your loss on contract, and immediately just have to take the entire figure. Game over. Okay. But then if if you get a profit on the debit side balancing figure, then what you have to do, the new syllabus students, what you can do is you can directly take it to the costing profit and loss. Take it on the debit side to costing profit and loss. Yeah, here to costing profit and loss. Simple as that for the new syllabus students. Yeah, but then for the old syllabus students and the BCOM, BBA and BAF students, what you people have to do, you have to do that split method. Yeah, what you have to do over here, first you have to recognize this profit, notional profit, not actual profit, just a rough profit. Yeah, because you are going to split that. Yeah, so see here, to notional profit, whatever the balance you get, take it as notional profit C by D, and then you have to take that over here on the credit side. Yeah, after tallying and all, by notional profit brought down, and then you have to split that into profit and loss and WIP reserve, work in progress reserve. Okay, you have to split that. See here, you took the balancing figure, bring it down, and then split it into two. Now this is the most tricky part. Yeah, you have to understand that how are you going to split this properly. Yeah, now don't think if you're new syllabus students, then you don't need to learn this, because if you are doing BCom, BBA and all these courses, then of course you have to learn this, because in these syllabus it's still not updated. They, it's done like this only, like old syllabus. Yeah, so that's what you have to do. So how are you going to split this into costing profit and loss and work in progress reserve? You have to understand that properly. See here, how much amount to be taken to profit and loss. So see, to do that you have to understand this properly. See, it's very simple. What you have to do is, first you have to find the degree of completion. Yeah, so how are you going to do that? You have to use this formula, work certified divided by contract price. Work certified divided by contract price into 100, you will get a percentage. Okay, that's called degree of completion. Okay, so find the degree of completion and then use this, this chart to calculate how much to go to profit and loss. Okay, so see here, for example, if you get it less than 25%, then nothing will go to profit and loss. Yeah, nothing will go to profit and loss. Entire thing will go to where? Entire thing will go to WIP reserve. Yeah, if this degree of completion, this thing is less than 25%, then nothing will go to profit and loss. Entire thing will go to WIP reserve. Is that clear? Yes. Then what? If this percentage is more than equal to 25% or less than 50%, then you have to use this formula. Notional profit, yeah, notional profit, this thing, notional profit into 1/3 into cash received, whatever cash that you have received from the contractee, divided by work certified. Okay, and that amount which you get, that would go to profit and loss, and the remaining balancing figure would go to WIP reserve. Okay, so that's what you have to do. And if this degree of completion is more than equal to 50% and less than 90%, yeah, what you have to do, you have to take 2/3 notional profit, the same formula, notional profit into 2/3 into cash received over work certified. Simple. Yeah, and whatever amount you get, transfer that to this costing profit or loss, and the remaining will go to WIP reserve. Then if it is more than 90%, if the degree of completion is more than 90%, that means what? The contract is almost over. Yeah, so now what you have to do here, you have to transfer on the basis of estimated profit. You have to calculate this estimated profit. See, how are you going to calculate the estimated profit? See here, estimated profit means what? See here, contract price minus actual cost till date, whatever cost that you have incurred till now, yeah, that you have to subtract, and then estimated cost. Yeah, the remaining estimated cost, whatever that you will have to incur, that thing you will have to subtract. Simple as that. You will get estimated profit. Yeah, whatever cost you have incurred minus, find the estimated cost. Yeah, these two things you will minus from the contract price. Okay, so you will get the estimated profit, and then you have to use this formula, estimated profit into cash received over contract price. Now there are many formulas actually, but this is the most preferred and the most appropriate formula. Okay, many formulas are there, notional profit formula is also there, but this is the most appropriate formula. Okay, estimated profit into cash received over contract price. Is that clear? Yes. So this is what you have to do to calculate how much amount to be taken to profit and loss. Simple as that. Yeah. Yes. So you get that, right? For the new syllabus students, directly you can take it to costing profit and loss, but for the BCom, BBA and then old syllabus student, what you have to do, you have to take it in notional profit, carried down, brought down. Yeah, you have to take it down over here and then split into two, to costing profit and loss and to WIP reserve. Is that clear? Yes. So understand that it's very simple. Yeah, it's very simple. This chart, from this chart you will understand the whole treatment. Yeah. Yes. So this is what you have to do, and then what you have to do is, and then you have this contractee account. See here the format of contractee account. Now this account will also be prepared in where? This will also be prepared in the books of contractor. Okay, in the books of contractor. Fine. So this contractee account, how you're going to prepare? What will happen? This contractee, this person, yeah, this person contractee, see here, this person will pay you amount in installments. Yeah, so he will pay you in the first year some money. Yeah, so it will come over here by cash. Yeah, because you're receiving the money, right? Cash account debit, you're getting the money from whom? From contractee. Yeah, cash account debit to contractee account. And this will be happening in the first year, second year, third year, whatever the length of the contract is, 4 year, 5th year, then like that. Yeah, so in the first year it will be like that. See, you have got the money. Yeah, contractee account. Yeah, contractee account credit, yeah, by cash bank account. Simple. And then what you're going to do, you're going to carry that forward, yeah, to balance C by D. Why are you carrying that forward? Because this is not the entire amount. Yeah, you have not completed the work. You're getting the money, but you have not entirely finished the contract. Yes, so it's like liability. You're getting advance over here. If you don't do the work, then you can also have to return it back to the contract. Yeah, so it's like liability for you, isn't it? So that's what you have to do. You have to carry that forward. Yeah, you receive the money, carry that forward into the next year, and then again here also you will receive the money, and then the balancing figure, again carry that forward, you will receive the money, and then at last what you will have to do when the contract is finished, at last in the last year you will have to transfer that to the contract account. Yeah, because you have received all the money, so it will come over here in the contract account on the credit side. Is that clear? You will take it over here. I have not taken it over here. You have to take it like, you know, by contractee account. Is that clear? Here it is to contract account, right? So the opposite side by contractee account. Simple. Yeah, so that's what you have to do. And then you will also have to prepare this balance sheet extract. Yeah, mostly in all the questions they will ask that balance sheet extract. Now this is not the whole balance sheet, okay? It will not tally and all. Here you will just show all the details that you have to show into the balance sheet in this extract. Okay, so it will not tally. Fine. So see, what you have to do over here is, what you have to do, you have to take all the closing balances over here, plant at site, plant at store, material at site, material at store. Yeah, and then here WIP also you have to show the closing balance. Work certified, what was the work certified you have to take, and then what is the work uncertified, you have to add it up. And then WIP reserve, this reserve you have to subtract. Okay, this reserve, see here, WIP reserve, this reserve you have to subtract over there. Yeah, and then the amount that you have received from the client, the cash that you have received, that also you have to subtract. Okay, so this is the total work that you have done, work in progress. Is that clear? So that's how you will do that. And then here you will take all the outstanding expenses. Yeah, you have to take the outstanding expenses here also and then here also. Okay, yeah, so that's outstanding expenses. And then the updated profit and loss balance also you will have to take it over here. Yeah, because it's reserve, right? So it will come over there. Clear? So this is what you have to do. Simple as that. And then one more thing I wanted to tell you was, see here, now when the work certified is 70%, yeah, 70 crore we discussed in that example, right? So now the contractee will not pay the entire money, okay, entire 70 crore. No, he will not pay that. Even though 70% of the work is certified by the architect, right? Still the contractee will not pay us the entire money, entire 70 crore. No, what he will do is, just for an example, he will pay us, you know, of that 70 crore, he will pay us only 90%, 0.90. Yeah, so he will pay us 63 crores. The remaining 7 crores, yeah, minus 70, the remaining 7 crores, what is this? The money which he hasn't paid, he has retained with himself. That's retention money. Yeah, for security, what he will do is, he will not pay us entire amount, he will not pay something, and that's something which he will not pay, that's called retention money. Is that clear? Yeah, so that's that. So you understand this, right? It's very simple. Okay, now we'll solve one problem and then you'll be clear with this. And then there is all the difference over here, right? For the new syllabus students, what you have to do, if there's a loss on contract for the old and new, it's same. If there is a loss on contract on the, you know, conservatism principle, you have to account for all the losses. So all the losses will be directly taken over here. But the profit for the old syllabus, what you have to do, you have to use the split method. You have to split it into profit and loss, and some of that you have to transfer to WIP reserve. Yeah, and for the new syllabus, nothing like that, just directly to the costing profit and loss. Simple as that. Yeah, simple. Yes, so this is it, right? This is it. Yeah, isn't it? Yeah. Okay then, see you in the next video. Yeah, bye.